You are highly welcome once again. Our program is, we shall be having our opening remarks by the registrar, Mr. Yorinde Adeonipekun, FCS. I want to specially welcome our moderator, our referred professor, Professor Uche Uwaleke, FCS. Also our facilitator, Dr. Biodun Adedipe. Thank you for joining us. We want to thank all our participants and everyone on the call. Your time that you have invested in this training, I assure you, will not be in vain. It's a program that has been well packaged, and the outcome is will be highly appreciated. Let me quickly thank our president, the 13th president, Mr. Orokpo S. Dada, and I want to recognize all the council members on the call of Chartered Institute of Stockbrokers of Nigeria. You are all welcome and you are all recognized. Thank you for all the hands on the deck that makes this possible. We appreciate you. Thank you. Let me leave the podium for our esteemed registrar, Mr. Yorinde Olanipekun, for opening remark. Adeonipekun.
Good morning, everyone. I actually welcome us to this special program, the Executive Breakfast, that we are having this morning, organized by Chartered Institute of Stockbrokers. I would like to, first of all, recognize the presence of our esteemed council members that are on this call. I appreciate them for taking out of their busy call. And I also want to recognize Professor Uwaleke, who is also on this call. Also want to recognize our lead speaker, our erudite professor that is also on. So without wasting much time, I quickly have a quick address. It is with honor and privilege as the registrar to actually do these opening remarks on behalf of the Chartered Institute of Stockbrokers. I want to extend the greetings of Mr. President, the 13th President and Chairman of Council, that he extend his greeting to everyone and actually given to this particular program. So I want to thank you for your time out of your demanding schedule to join us for this, what promises to be a highly engaging and insightful discourse on a subject of immense relevance to the Nigerian capital market and broader economy. Today's theme, consolidating the gains of 2025 bull market strategic approaches for Nigerian investors to achieve enhanced performance in the current year, is both timely and thought-provoking. It reflects not only the remarkable journey of our market over the past year, but also responsibility that lies ahead of us as professionals, investors, and market operators to sustain and build upon these gains. The year 2025 will undoubtedly be remembered as a defining period in the evolution of Nigerian capital market. It was a year marked by resilience, renewed investor confidence, improved liquidity, and notable growth in market capitalization. Against a backdrop of macroeconomic adjustment, policy reforms, and global uncertainties, the Nigerian stock market demonstrated remarkable strength regarding disciplined investors and reaffirming its position as a viable avenue for wealth creation. You will recall that the equity market gained about 51% in 2025. And as of yesterday, 21st of April 2025, the market has gained about 40%. This is remarkable. However, while it is appropriate to celebrate these achievements, it is even more critical that we approach the current year with strategic intent, informed judgment, and a clear understanding of emerging realities. Bull markets, by their very nature, present both opportunities and risks. History has shown that markets move in cycles, and the ability to consolidate gains often distinguishes successful investors from the rest. This is precisely why today's conversation is as important. As we navigate the current year, several key dynamics are shaping the investment landscape in Nigeria. We are witnessing ongoing economic reforms aimed at stabilizing the macroeconomic environment, including fiscal adjustments, monetary tightening measures, and structural reforms designed to enhance productivity and attract foreign investment. While these reforms may present short-term challenges, they also lay the foundation for long-term growth and market stability. In addition, technological advancement continue to redefine the way we engage with financial markets. Digital net trading platform, data analytics, and financial innovation are expanding access to the market and empowering a new generation of investors. At the same time, global interconnectedness means that developments in international markets increasingly influence domestic performance, making it imperative for investors to adopt a more holistic and informed approach. Against this backdrop, the question before us is clear. How do we consolidate the gains of the past year and position ourselves for enhanced performance in the current year? First, it requires a shift from opportunistic investing to strategic investing. The gains recorded during a bull market can sometimes create a false sense of invincibility, leading to speculative behavior and excessive risk-taking. As professionals, we must emphasize the importance of fundamentals, sound financial analysis, proper valuation, and a disciplined investment approach. Sustainable performance is not achieved through speculation, but through informed decision-making and long-term planning. Second, diversification remains the cornerstone of effective portfolio management. The Nigerian market offers a wide range of investment opportunities across sectors, including banking, telecommunications, consumer goods, energy, and emerging industries. Investors must be encouraged to spread their risk, taking advantage of sectoral strengths while mitigating potential downtimes in any single segment of the market. Third, there is a growing need for investor education and protection. As market participation increases, particularly among retail investors, the role of professional guidance becomes even more critical. The Chartered Institute of Stockbrokers remains committed to upholding the highest standard of professionalism, ethics, and competence within the industry. We will continue to invest in capacity building, certification, and public enlightenment initiatives to ensure that investors are well informed and adequately protected. Fourth, we must recognize the importance of policy consistency and regulatory stability in sustaining market growth. The collaboration between regulators, market operators, and policymakers is essential in fostering an environment that encourages investment, enhancing transparency, and build trust. As an institute, we will continue to engage with relevant stakeholders to advocate for policies and support market development and economic progress. Furthermore, the role of international investors cannot be overstated. Pension fund asset managers, insurance companies, and other national players have the capacity to provide the stability and depth to the market. Their long-term investment horizon position them as key drivers of sustainable growth, strengthening institutional participation with the critical consolidating the gains achieved during the bull market. Ladies and gentlemen, it is also important to highlight the significance of corporate governance in this conversation. Strong governance practices enhances investor confidence and contribute to market integrity. Companies that demonstrate transparency, accountability, and ethical leadership are more likely to attract and retain investment. As stockbrokers and market professionals, we have a duty to promote and uphold this standard across the board. As we look ahead, we must also consider the opportunities presented by regional and continental integration. Initiatives such as African Continental Free Trade Area, that's AFTA, have potential to unlock new market and investment opportunities for Nigeria. Businesses and investors, by positioning ourselves strategically, we can leverage this development to drive growth and expand market influence. The executive breakfast has been carefully designed to provide a platform for meaningful dialogue, knowledge sharing, and strategic insight. We have assembled two great professionals and scholars who will share their perspective on market trends, investment strategy, risk management, and emerging opportunity. I encourage you all to actively participate in this discussion, ask questions, and engage with the speakers. The value of this session lies not only in the presentation, but also in the exchange of ideas. Let me also take this opportunity to reaffirm the commitment of Channel of Stockbrokers to the development of the Nigerian capital market. As the apex professional body for stockbrokers, we remain dedicated to promoting professionalism, enhancing market standard, and contributing to national economic development. We will continue to collaborate with regulators, government agencies, and other stakeholders to ensure that our market remains robust, transparent, and globally competitive. In closing, I would like to emphasize that the journey of investment is not defined by a single year or a single market cycle. It is a continuous process that requires discipline, adaptability, and foresight. The gains of 2025 provide us with a strong foundation, but it is our actions in the present that will determine the sustainability of these gains. Let us therefore approach the current year with clarity of purpose, strategic thinking, and a commitment to excellence. Let us leverage our collective expertise to navigate uncertainties, seize opportunities, and deliver value to our clients and stakeholders. And above all, let us work together to strengthen the Nigerian capital market as a catalyst for economic growth and national development. I thank you once again for your virtual presence and participation, and I wish you a productive and insightful session. Thank you, and God bless. So I think the next item is to invite Professor Uwaleke, who is sharing this session, to actually take over from there. Thank you, everybody, for your time. And attend this very wonderful program that we are having today. Professor Uwaleke, sir.
Thank you. Yeah, thank you. Thank you so much, my registrar. The 13th president of the Chartered Institute of Stockbrokers, other council members here present, registrar and CEO, my good friend, Dr. Adewale Cephas, distinguished participants, and members of the capital market community. Permit me to rest on protocols already established by the registrar. It's indeed my pleasure to welcome you to this timely webinar organized by our great institute, the Chartered Institute of Stockbrokers, themed Consolidating the Gains of the 2025 Bull Market. Strategic approaches for Nigerian investors to achieve enhanced performance in 2026. Now, the choice of this theme could not have been more appropriate, just as the registrar said. The Nigerian stock market, as we all know, closed 2025 on a remarkable note, ranking among the best performing markets globally, with returns exceeding 50%. That momentum has carried into 2026. We have seen year-to-date return at about 40% already, and market capitalization surpassing 140 trillion naira. Now, this has been despite all the shocks and the challenges, persistent geopolitical tensions, including the Middle East conflict. What is particularly encouraging is that this performance is underpinned by improving macroeconomic fundamentals. We are all witnessing greater exchange rate stability, steady GDP growth, 0.87% last year, and is projected to grow by 4.1% this year. Stronger external reserves. We've seen external reserves, gross external reserves cross the $50 billion psychological threshold. And of course, moderating inflation, particularly when you look at the trend where it was before. The latest figure we have now is 15.38% as of last month. Now, in addition, structural and regulatory developments continue to strengthen the investment climate, ranging from the anticipated listing of the Dangote refinery to improved investor confidence following Nigeria's from the gray list of the Financial Action Task Force, as well as the implementation of the new investment law in Nigeria, the Investment and Securities Act of 2025. Equally important are ongoing market infrastructure enhancements, such as the proposed transition to a T+1 settlement cycle. You recall that last year, November, the market transited to T+2 settlement cycle. That's for the equities. There is also the plan to extend the trading hours of the NGX from 9 a.m. to 4 p.m. Capital market operators. All of these are designed to deepen liquidity, enhance efficiency, boost investor confidence. However, just as the registrar rightly noted, as history and market experience remind us, bull markets do not move in a straight line. Periods of consolidation are both natural and necessary. They present investors with critical questions. How do we preserve gains? How do we navigate emerging risks? And how do we position strategically for the next phase of growth? To help us unpack these issues, we are privileged to have with us a highly respected banker and thought leader, Professor Biodo Adedipe, who will guide us through the key drivers, the risks, and strategic responses required in the evolving market environment. Now, I'm going to welcome Professor Adedipe to help us unpack these issues. But before I do that, permit me to read his profile, the way I've abridged it. As a matter of fact, Professor Adedipe is someone that doesn't need any introduction to most of us on this call. But by way of formality, I will still read his profile, the abridged form. He has a very long, rich bio, but I will abridge it for want of time. Now, Professor Biodo Adedipe is the founder and chief consultant of B. Adedipe Associates Limited, BAA Consult. With over 45 years of postgraduate work and professional experience in university teaching, investment banking, project finance, management, and financial consulting, as well as leadership in business and not-for-profit organizations, Professor Biodo has had an illustrious career that took him to the University of Lagos, Enterprise Consulting Group, the World Bank, Africa Region, International Merchant Bank PLC, and First City Monument Bank PLC. He received a doctorate degree in industrial economics, specializing in corporate finance from the University of Lagos as far back as 1989. He holds a BSc, and I must emphasize first class in economics from the University of Ife, now OAU, in 1980. He has also bagged several awards in the process, including the Sir Adam Thompson Scholarship as visiting doctoral student to the University of Sussex in the United Kingdom. This was in 1984. Professor Adedipe is a member of several respected professional bodies and membership associations, including the Chartered Institute of Directors, Nigeria, where he is a fellow and council member, Chartered Institute of Bankers of Nigeria, fellow and chairman of Strategy and the Advocacy Committee of Council, the Nigerian Economic Society as a life member, American Economic Association and Lagos Chamber of Commerce and Industry as council members, and chairman, Economics and Statistics Committee. Professor Abiodun is also a member of the Capital Market Academics of Nigeria. He founded BAA Consult in February 1993, and he was responsible for charting and managing the firm's strategy and activities since operations commenced in March up till May 2024 when he retired from the firm. He sits on the boards of a couple of profit-seeking and non-profit organizations in diverse capacities as chairman, non-executive, non-director. Distinguished ladies and gentlemen, that is the profile of the man that we are about to listen to. You will agree with me that as far as this topic is concerned, the CIS couldn't have settled for a better person. So I now have the pleasure to invite Professor Abiodun Adedipe to take us through his presentation. Please take notes, and of course, at the end of it all, we welcome contributions, comments, and questions from members who are participating in this great webinar. Thank you very much. Professor Abiodun Adedipe, the floor is yours.
Thank you so very much, my brother, my friend, professional colleague, I would say, Professor Uche Nwaleke. Very proud of you and also happy to always share the platform with you. You know, each time we are together, what comes to my mind first is I'm in a safe territory. That if there's any big question that comes my way, I have somebody very close by who can bail me out.
Thank you, Prof. Thank you, Prof.
Thank you so very much. And let me also rest on the protocol which has been well established by both the registrar and the distinguished moderator here, Professor Uche Nwaleke, recognizing our 13th president and chairman of council, my very good friend and brother, Sarok Dada, of course, distinguished council member that are here, the registrar, Mr. Yorinde Adeonipekun, and also for that fantastic opening remarks. I mean, there were two important things I picked out from there, which I will just comment on before I move into my slide deck. And of course, also the leadership of CIS Academy and distinguished professionals, ladies and gentlemen present here. Now, I picked on two important things that the registrar mentioned in his opening remarks, and that is the place of professional guidance by stockbrokers. And that, in fact, for me, is fundamental to the conversation we're having today, which is understanding the environment, the market, the risks, the opportunities, and then having someone who will provide guidance for investors within the context of that morass of information, data, and other issues coming up within the market. But most importantly, and this was the way your remarks struck me in that regard, that you cannot give what you don't have, which means for us to provide professional guidance, we ourselves must be well grounded. And that is why I also congratulate CIS Academy for this executive breakfast. The second thing you mentioned is the key role of corporate governance, which of course we know is central to whatever we are seeing today in terms of investor confidence, not only in the Nigerian economy as a geography, but in our stock market, and then carrying to respective stocks that are listed in that market. So that said, I will share my slides, and then we take a conversation from there. As Professor Nwaleke said, please, distinguished ladies and gentlemen, take your notes, and then if you have comments or questions, we take them together at the end of my presentation. And let me also say upfront that what I'm going to share today will be available to every attendee, and there is no copyright, which means you can freely use it, and of course, maybe even remove my name from it and put your name and use it straight away. Right? That's to make it more interesting. Consolidating the gains of the 2025 bull market, strategic approaches for Nigerian investors to achieve enhanced performance in 2026. I put a byline there. What are the issues? What are the drivers? What are the risk implications? And how do you respond to those issues? So I have this outline that has 6 elements in all. Introduction, then looking at consolidation for the perspective of an individual stock listed on the exchange, and of course, consolidation for the perspective of the market, which really the technical aspect of this, a very interesting one. But I also was careful to ensure a balance between getting an understanding of consolidation and then going through technical. So I had to stop at some point. So we look at that. Then, of course, what are the market realities and drivers, which my brother and friend, Professor Waleke, have done beautifully, giving us an overview of that. Then what is the outlook? What are the expectations? Then what are those strategic choices that an investor can make in a consolidated market? Then we summarize and conclude. Now, some 6 years ago, just about this time, in 2020, a month before, that's in March 2020, the World Health Organization declared COVID-19 as a pandemic, meaning a global health crisis. At that time, we came up with this concept of VUCA as representing the new normal. All of us in the world have come to say we're now operating in an environment that is volatile, that is uncertain, that is complex, and also ambiguous. So that became the new acronym. We call it the new normal, VUCA world we operate in. But 6 years down the line, when we began to get an understanding of VUCA, and now it was shaping government policies in terms of response, it was shaping corporate efforts and strategies, which for me at that time, I said that every corporate entity around the world must look at 3 important things. The first was how to survive that disruption. The second was how to stabilize. And the third plank was how to restart growth. That was the way I interpreted it for corporate entities in 2020, second half, and then in 2021. But when the convention now began in 2021, we said now, what will be the next normal? We already knew the new normal, and we said, what will be the next normal? That means when another set of massive disruptions come, what are we likely to experience? Then along the line, somebody came up with this, and it's called BANI, which is what we are experiencing today. The next normal is here, which means the environment we operate and invest in is brittle, it is anxious, it is non-linear, and also incomprehensible. Let me just speak to non-linear there. Non-linear means, as an investor in the Nigerian stock market in 2025, you had an interesting run. If your portfolio mimicked the market, you should have ended with 51.19% return on your investment, okay? Assuming your portfolio mimicked 100% the performance of the market. So but what the word non-linear now means is that we are in 2026, that what we see in the market and what we'll experience and what you also choose to do may not likely produce the same return for you if you repeat what you did in 2025, which means it is non-linear. And that is why this conversation today is very, very important to understand what now are the peculiarities of the situation we are dealing with today. So now the basic issues, and interestingly, between the 2 speeches we have had, the registrar and Professor Waleke, we've had this also mentioned, what I call basics, 5 important roles of the stock market, of like broaden it and say capital market in a modern economy. First is capital formation, which of course the registrar made reference to specifically, through capital raising that catalyzes growth and expansion. Secondly, wealth creation. Professor Waleke mentioned that as well in his speech. Okay, for investors, through capital appreciation and dividend payout. Liquidity, which in my own understanding is a key component of portfolio management. And I mean, this is something we deal with on an ongoing basis. I'm involved with at least 4 major asset management companies. One as a consultant, 2 of them as chairman of the investment committees, 1 of them as chairman of the board of directors. And so each time we either meet as the board or we meet as investment committees, I have to stand out and give my advice to in fact, maybe I would say the market leader within that space in how to relate with their clients. All right. So the question is, what are those primordial 3 fundamentals of portfolio management? First is capital preservation. And then the second we say is the return. The third one is liquidity. So which means that it is not enough to talk about creating capital, all right, and wealth. You also want to ensure that your portfolio is liquid. Then, of course, the market is good for price discovery for listed stocks, which for me I interpret as an opportunity that is not available from privately held stocks. In fact, when I wrote this down, my mind flashed back to 1992, April, when I joined FCMB as chief economist and head of strategy. Of course, given my level then, the bank also offered me shares to buy. But at that time, FCMB was not listed. And so that meant the price at which the bank would sell those shares to me will be determined by the bank. That's number one. And if I was now to exit like I did some 4.5 years later, at the end of September 1996, it meant the shares of FCMB I had then, the price also will be determined by the bank itself, which case at the point of purchase and exit, the bank would determine how much I will pay. So I now said, hey, because it's privately held, that means it's so easy for the stock, that's talking about the bank now, to shortchange me. I say, look, okay, at this time you are exiting, the price per unit is this much. So it can fit the price lower than my entry point. So, but once a stock is listed in the market, then it is open to an opportunity of price discovery. Last of them, and very, very important too, is that the stock market is an economic indicator where we say it is a barometer of the health and attractiveness of the economy. You see how this becomes important in, the next few slides. When I get there, I will connect to this particular one. What now are the characteristics of bullish markets? What do you see there? What are those things you see and make you, infer that we are now fully in a bullish market? Number one is rising prices, which means when you check the trends of prices, generally they are in the uptrend. All right. Secondly, there is high investor confidence, in which case, let me say something here, that anytime you hear that there is a black day, whether you call it Black Friday, as you know historically, or Black Tuesday, whatever you call it, where the market more or less collapses, it is simply because most investors choose to sell. So most stocks are on offer. Once that happens, the market is on the way to dampening. But of course, when most stocks are on bid, by all means, prices will continue to go up. But behind that is investor confidence. So what we always say then is, from policymakers, like, our registrar said in his remarks earlier on, that's talking about the stakeholders, from policymakers to regulators to market operators, even the participants themselves, investors, and every other stakeholder in the ecosystem. Everyone must be saying what is positive about the market and the investment environment. So that is how to sustain confidence to start with. But most importantly, we say about policymakers, what we call significant utterances of key government functionaries. Very, very important in investor confidence. Then, of course, economic optimism, which means what do we expect of this particular economy going forward? Let me again make a reference to something that happened about 21 years ago. This was in 2005. You recall then we're going through the round of bank recapitalization, which began in July 2004 by the then governor of the central bank, Professor Charles Soludo. Okay, so when the process began, one of the international banks came to our firm to ask us, what do you advise us to do? It was, of course, pro bono. Okay, what do you advise us to do? Should we bring this 25 billion? We can afford it, all right? So it's not a big deal. We can afford it. Or should we just exit Nigerian banking? And I told them, I said, look, before I will answer that question, let me ask you a question. What is your view about the Nigerian economy? Do you see it growing further than where it is currently? Remember, they came to me early 2005, not exactly 2004. So we had a discussion around that for about 10, 15 minutes. We agreed that, look, Nigerian economy will continue to grow. I said, okay, fine. Now, if the economy is growing, what does that imply for banking business? They said, well, that is very straightforward. In a modern economy, banking is fundamental. So if the economy is growing, by all means, the need for banking and financial services will be there. Of course, it's a different need to say whether banking services are needed and whether it is bank that will provide it. That's a different conversation entirely. So I said, okay, if we all agree that this economy will grow and therefore create new business opportunities for banks, then that will then bring me back to your question that the 25 billion we are talking about today in a couple of years will really not mean much. Now, I now told them their own history, which they didn't even remember. I said in 1989, I ran a research, a study of what we call sustainable growth path in Nigerian banking. And that your bank in particular was growing along a sustainable growth path. And there was a particular year, I think about 4 years later, I was then in FCMB. I said, I observed that there was a particular year that your bank paid dividend that was exactly equal to the value of your paid up share capital. Which meant that very year alone, dividend from that year alone, repaid all the investors in your equity. They said, oh, we didn't even see that way. I said, I saw it way back, sometime in 1985, 86 or so. I said, so what this tells me that if I look forward to the next 5 years, this 25 billion will mean nothing again to your bank. Now, ladies and gentlemen, just this point alone, within the next 2 years, that international bank that was at that point in time in the hired premises, in fact, they were tenants of Lagos Chamber of Commerce and Industry, were the Commerce House. But thereafter, they bought the property, redesigned it, and so that became their national headquarters as of today. Now, positive feedback loop means that every stakeholder within the ecosystem is positive about the market. And so conversations, and of course, even the data analyzed and all of them give positive feedback, and it begins to feed itself. It becomes a loop, all right? And of course, sector rotation also, which means there's relative attractiveness of different sectors. And again, if you notice earlier in the speech of the registrar, it made reference to banking, to telcos. It made reference also, of course, Professor Waleke made reference to energy, where we also talked about the impending listing of the Dangote refinery. All of these are what we capture as sector rotation, which means different sectors create their own attractiveness and they continue to sustain the positive feedback loop. Now, that said, let's also talk a little about market risks. Of course, earlier, again, as I said, Registrar made reference to this in his speech. Stock market risk refers to the potential for financial loss due to fluctuations in stock prices influenced by economic, political, and systemic factors. But this is something I always tell investors, the stock market. Now, the pattern is that if you enter into a particular stock, that's at the entry point, let's assume the price was 10 naira. Like when I bought the shares of GTB and Zenith Bank in 2004, just before Soludo announced the consolidation of banking in July 2004. I bought the shares of those two banks, but they went to the market before the announcement. And so when people said, oh, they had an inkling, I said, well, when they went to the market, Soludo was not even yet appointed as CBN governor, so it couldn't have been. So that just forget about that argument, okay? But when I bought the shares of those two banks in 2004, I also did something. I encouraged every staff of BA Consult to buy. I gave them my own personal money to buy the shares of those two banks. So every staff of BA Consult, as at that point in time, became a shareholder of those two banks from the monetary gift I gave to each of them, personal, not from the company's coffers. Now, I had to now school them that stock prices oscillate. Market oscillation means prices go up and they come down, all right? So, and I told them that, look, if we bought the shares of DTB at 10 naira, and let's assume the share price drops to 5 naira, if you have not sold your own, stock, then you have not lost any money. Loss only occurs when the price at exit is less than the price at entry. As I said, so you need to understand that when you are now investing in the market. Now, market volatility, of course, reflects the frequency and depth of the fluctuations. And that is where I will later now explain what consolidation means. So participants in the stock market, therefore, need to also understand market oscillation, which is similar to sunset and sunrise. In fact, this became a big issue when we were discussing the global financial crisis of 2009 to 2010. Because I did a lot of work there for not only Central Bank of Nigeria, many of our banks are some foreign entities as well, and some players in the London market. So now, I told them that, look, when it comes to markets, it is like sunset today, but when the sunset, you are sure definitely that the sun will rise again tomorrow. So which means that whenever the sun sets, you have that expectation it will rise again. So if, therefore, you have some stock today that is priced dampening, it is not a pointer to consolidation yet. And I will explain that when we get there shortly. So as I said, whether an investor profits or loses as a result of market fluctuations is a matter of relative stock prices at the points of entry and exit, which I just explained. Timing them becomes an important part of stock market investment decisions. And that's the key thing in our conversation today. So risks in the stock market are systematic and non-systematic. Systematic risk refers to the overall market dampening that results in reduction of the value of most stocks due to inflation rate, which has two components here. And this is important to note as professionals in this space. There's a difference between actual inflation rate, the latest one that Professor Uche Waleke mentioned earlier on, 15.3% for March 2026 for Nigeria. And then the expected inflation now, most people link to what is happening in the Gulf states, that is the Gulf War going on now. And the argument is that if the disruption coming from the Gulf states, especially from that narrow strip of water called the Strait of Hormuz, where you have the narrowest point as 21 nautical miles, okay, where no vessel can pass through. I will now interpret the realities of the data. 20% of the crude oil produced and supplied to the market but was passing through that, because that has changed now, okay, about 20.9 million barrels per day. And of course, 30% of LNG and another 20% of fertilizer, all right, the urea type, which is different than the one that produces in Nigeria. Now, if you look at all that, and then the implication generally for not only the global economy, but also for different geographies, take Europe especially, they will take East Asia as well, the vulnerability of Japan, 70% of energy imported, South Korea, about 30% of energy imported. They'll talk about India, and of course, several other countries, Bangladesh, which of course is almost collapsing. Sri Lanka is just recovering from the oil crisis that impacted the economy in 2022. And now you talk about buffers. Then you also talk about vulnerability. So how resilient, how vulnerable is our economy? We'll get to that shortly. Then interest rate, exchange rate, sovereign risk, That is for anyone to come to invest in Nigeria. There's a particular transaction that our firm was involved with. We are still part of it. It's still ongoing, where we had access to some funds from the US and UK market, about $100 million. And then the pricing now came as LIBOR was used then, LIBOR plus. But the plus they had on top was now to take account of sovereign risk. That if that money is coming for a project in Southeast Nigeria, this is the risk premium. And by the time we put the risk premium, about 8% then, with LIBOR, which was going for about 4% thereabout, we said, look, that rate was close to what a bank in Nigeria offered us for this project. So why should we take that loan? And of course, that's just to illustrate the place of sovereign risk, all right? Of course, geopolitical events, movements especially in the three macroeconomic prices are considered relative to returns. What I call three macroeconomic prices are inflation, interest, and exchange rates. Now, specific or unsystematic risk is peculiar to a particular company or industry due to any or combination of management changes, product failures, damaging competitive moves, which will be local or international, the major policy shifts and regulatory actions. So in very broad terms, the stock market also demands attention to volatility and also liquidity risks. Now, I'm sure many of us are familiar with this book titled Read That Poor Dad. The author of that book, Robert Kiyosaki, made a statement, or he said, for every benefit, there's a risk. And for every risk, there's an opportunity. So which means I picked this up because it struck me in context of consolidation that we are discussing today. That yes, there are benefits in a bullish market, but that benefit also comes with a risk, like Professor Waleke said earlier on. Okay? But for every risk you also identify that will make you want to run away, there's also an opportunity. So in which case, you want to look out for both ends. What are the opportunities and what are the risks? How do we balance them? Now, let me say a little about individual stock and market consolidation. What are the fundamentals? Tim Fries of Tokenist made this statement in a blog he wrote in February 2025, that stock consolidation is a term that is used to refer to a stock that is neither going up or down, or even if it is moving at all, it's only going up slightly to return to where it was before and vice versa. So in which case we say that that stock is trading within a range. Now, consolidated stocks are typically recognized by the fact that they only trade within a very limited price range. So if you look at our market today and look at the stocks and their prices, a very good number of the stocks presently are trading within a limited price range. As we say, those stocks have consolidated. But we'll come back to that later. Now, consolidation in the context of trading, that's now from Faster Capital, refers to a period, we are not talking about period, right, where the price of an asset moves within a confined range, often after a significant upward or downward trend. Okay? That means this stock has moved significantly, okay, and or either up or down, but suddenly stabilized. At times we call it, it has plateaued. Okay? This phase is characterized by a balance between supply and demand, indicating that the market is taking a breather. That means let's wait at this point and see before we move again. So traders often view consolidation as a time of indecision, but it's also a period ripe with strategic opportunities. For those who know how to navigate it, that's what should be known, not now. I will correct that before I share, okay? Those who know how to navigate it. So a stock in consolidation typically demonstrates three characteristics. Number one, establish support and resistance level. That means, like I said, within a narrow band or range, which means there's little or no oscillation, all right? The narrow trading range, oscillation is within a defined narrow band, and that's why I illustrated it lower down here. There are no major trading spikes. So which means there's a balance between price and volume movement. And we must also interpret narrow band correctly. In fact, the example I saw when I checked this out, in my research, was comparing Bitcoins, okay, to some selected stocks in the US stock market. And when I came across that, my mind went back to 2022 when I did some work for Central Bank of Nigeria on cryptocurrencies, part of what also became what led to the e-Naira that we have today. Now, if you look at the 5% price variability for Seplat, which was at 10,450 Naira, okay, that 5% is about 63.4% of the price of BUA foods at 824.6 Naira, okay? So quick means a 5% price variability on Seplat is huge and significant compared to 5% variability of the price of BUA foods, just to illustrate, okay? Even BUA foods itself in terms of the price is way, way above several stocks listed on our market. So in which case, you can pick a particular stock and in calculating whether it is as consolidated or not, it can be a matter of the size, that is how much in Naira Kobo the price varies. Rather, it is better to look at the percentage variability. So now consolidation can also be a temporary break, followed with either an upward movement, which is called breakout, or a downward movement, which is called breakdown in the price of a stock. So now, and this is bringing it together and more interesting. Now, this same concept of consolidation applies to the entire market. And that is when the argument arises as to whether the market has reached a peak and which correction is likely to happen. And it gets more interesting here. So I started with the question: is the Nigerian stock market at the present moment at the consolidation point? Now, if anybody thinks so, which is if you check the data, all right, if you look at the data in January 2026, that will suggest that, oh, our market has gone into consolidation point. But of course, if you look beyond January 2026 and consider February till date, the question is, how will it likely proceed from here? So, but that can be clarified by asking another question. How did the market get here? If we know how it got here, then we can begin to form opinion of how it's likely to progress for the rest of 2026. Unless, like I always say in financial matters, there's a thunder strike. So if there's no thunder strike, that thunder strike means a massive disruption and dislocation to the markets and economies. All right? So now, let's look at the market realities and the drivers. And this is where it also gets even more interesting. This is the chart I constructed of the Nigerian stock market between end of May 2023, when President Tinubu came into office, up until yesterday. That's what this chart represents, the data. So now, the current bull market run, if you look at this chart, began in June 2023, because the market responded, or let me say has responded, to two important things that the registrar also mentioned. Market reforms, where Ochiwaleki also mentioned that, in fact, particular market reforms, the ISA 2025, 3+1 settlement, trading hours extension, and all of those are issues dealing with market reforms, okay? And also macroeconomic research, where I took account of major policy shifts since then till date, over 30 major policy shifts, okay, initiated by the Tinubu administration. But this is what it resulted in. But now, what are the particular things behind this? Now, to start with, I said, okay, let me take December 2022, the preceding year, to when this bull run began. What was the year-to-date return, end of 2022? 19.9%. Of course, year-to-date gain, market capitalization equities, 25.2%. Now, as at May 2023, that was before Tinubu sat on that desk, all right, 8.82% year-to-date return. By the year 23 ended, by the time 23 ended, the year-to-date return was 45.9%. Compare that with December 22. That's a massive shift. So if anyone thought, okay, we had a very good run in 23, how about 24? Of course, you recall also, we see that shortly. Inflation in 2024 was completely crazy. But by December 24, we of course did inflation rebates and all of that. Now, for that year to-date return was 37.65%. Then 2025, we thought about this very early. 3 or 4 that have spoken so far have made reference to that, 51.19. But of course, if you look at the figure, as of yesterday, I think it was 40.4%. I didn't remember to change that. Okay, as of yesterday, 40.4%. Now, if you now go back, end of 2023, up until yesterday, 21st of April 2026, the NGX index rose by 291.34%. And I have a reason for picking that, which I will explain to you in a moment. And the market capitalization equities only by 362.75%. Those are pointers to a bull market. There's no doubt about that. But if you look at that performance, it is stronger when compared to those of the reforming original BRICS. The original BRICS, you have Brazil, Russia, India, and China. South Africa was not there. You know, what Goldman Sachs put out in 2004 as the new building blocks for the global economy. That was the way they titled the publication, the new building blocks for the global economy. They identified these 4 countries and said the way their stock markets are behaving and what they had become between 2000 and 2004, it was a place international investors should be in. So I now went back again, in the light of what CIS Academy asked me to do, went back to Brazilian Bovespa Index. What was the growth rate over that period? 73%. Russian MOEX, 103%. International Stock Exchange, 65%. Chinese MSCI, 190%. So I now said, okay, if I look at this over a 4-year period, can I do a similar thing with the Nigerian Stock Exchange over the last 4 years? And of course, it shows a stronger performance. So our market is responding to reforms and market reset the same way the markets of Brazil, Russia, India, and China reacted, which in fact was what gave birth to Vision 2020, because I was also involved in that. And it was indeed all credit to Professor Soludo. And I always like to remind Nigerians that the credit should go to him for Vision 2020. But it was the one that led the idea of Goldman Sachs and invited 3 or 4 supervisors CBN to join the top management of Central Bank. Then they presented the paper and said, look, what do we think? That is vision for Nigeria to have an economy that is among the top 20 in the world by year 2020. So how do we go about that? So that gave birth to financial sector strategy for year 2020. But it was what happened with the stock markets in these 4 countries that were now growing very strongly, the economy as well, because of reforms. So, like we said earlier on, if an investor's portfolio mimicked the market in 2025, he should have made 51.2% return on investment. Now, this last year, Professor Waleke mentioned this, was relatively strong when compared to global stock market returns in 2025, because the global stock markets in 2025 was dominated by European stock markets, generally driven by easing monetary policy. Nigeria and Kenya this year, and I think which other country now, is it Ghana or so, are reckoned in 2026 to have space for monetary easing. But I'm not going that direction, all right? Equal economic recovery in Europe, and of course, defense spending. So, but now I said that is general for European stock markets in 2025. What are the specifics and what was the year-to-date return end of the year? Top of the list was Greece with 60%. And what drove that of Greece? Recovering economy and banking sector reforms. So you now will see some things we can pick out in forming an outlook for the Nigerian stock market for this year. The Czech Republic came second with 53.4%. All right. Recovery and growth in Central and East Asian European market was what drove their own. The reason I put those 2 in the same color with the return on the Nigerian market, first bullet point on this slide, was because if you pick out those 2, the next globally was the Nigerian stock market. which is in terms of return, we placed number 3 in 2025. So then, of course, Poland followed with 48.4, driven by economic improvement and investor sentiment. The Hungary, 46.7, increased and positive market sentiment. Remember, we talked about investor confidence and, of course, positive feedback loop as indicators of a bullish market. And I'll say, okay, let me take 2 of the matured markets and place return, year-to-date return, end of the year, against that of Nigeria and this European market. And now also tease out why they experience that growth. Japan came with 26%, driven by economic growth, corporate governance reforms. Our registrar mentioned that in his opening remarks. And of course, market sentiment. Therefore, US came at 16%, which of course, in reports variously on stock markets, show clearly that European stock markets outperformed the US, which had been always the reference most of the time. But what even drove that of US in lower energy costs last year, the ballgame is different in 2026, especially with the US-Israel war on Iran. The lower interest rates, of course, interest rate by all means cannot go down any longer. That's by the conspiracy of POTUS, that's President of the United States of America, who said, look, I don't want Powell in that office again. Once your time expires, me out of the office. He even threatened some few days ago that if Powell doesn't go by May, it will make trouble for him. So that now the reality of data in the US economy is showing that the Fed cannot immediately begin to lower interest rates. Okay? Inflation, of course, stabilized in the US, is ticking up now. And of course, there was AI augmented earnings growth. Now, coming home to Nigeria, why are the market being bullish? Very interesting. You know, there's something I play around. I have 3 different slides like this. I call them my macroeconomic dashboard. But for the purpose of this convention, I call them performance drivers. These are the major metrics. There are many others, okay, to measure any macroeconomy. But these ones I selected a few years back. So that is what I keep updating every day. So where were we end of 2024? Where were we end of 2025? Where were we end of business yesterday? So I have 3 like this on this slide deck. So this shows you where we were: exchange rate, growth rate of the economy, monetary policy rate, inflation rate, capital importation, price of crude oil, production of crude oil, stock index, market capitalization, FX reserves, then how many months of cover, external reserves. Now, if I just change this slide, you will see how these numbers change. So that will tell you that there are interesting changes happening around. End of 2025, economy grew at 3.87%, better than 3.38 in 2024. Exchange rate, what happened? Appreciation of 6.97% at the official market in 2025, whereas there was diminution in value of 41.4% in 2024. How about parallel market? A similar thing played out. Appreciation even better in the parallel market at 12.08%. Value diminution lower in 2024 at the parallel market. The premium was 3.78%, an improvement over 8.74 end of 2024. Then monetary policy rate, of course, dropped from 27.5 to 27, and we can see that also. Inflation rate dropped from 34.8 close of 2024 to 15.15% close of 2025. Capital importation more than double, almost doubled, okay, from 12.32 to 23.22. Price of crude oil, of course, lower, higher end of 2024, lower as 3.4 to end of 2025. The oil production higher, 1.34 to 1.46. The stock market index, you can see 102, end of 2024, 155, thousand, end of 2025. Market capitalization the same. But look at foreign reserves. End of 24, where Waleke mentioned this, 40.88 billion gross, end of 2025. By the way, this gross is also a 30-day moving average. It's not the actual. But what I want to bring out is once you see this moving average going higher, it means the actual must be greater than 45.5 billion. Okay, that's what it means. But what is more important is how many months of cover. And that's the beauty of the situation where we are currently. As of yesterday, this was where we were. The exchange rate at the official market yesterday was 1,350 naira 74 kobo to the dollar, showing appreciation of 6.29 so far this year. Parallel market, 1,400 naira to the dollar. Of course, 6.43% appreciation. But if you take, let's say, what GTB puts out every day at the exchange rate, if you use your Naira card to pay for any transaction in foreign currency, yesterday was 1,349 naira. Or no, 1,359, greater than official, but significantly less than parallel market. So in the review of this, along with my wife yesterday, we said that means it makes a lot of sense to leave your Naira in your bank account, use your Naira card to pay for any foreign transaction, because the exchange rate you pay with the Naira card is much lower than the parallel market. So it doesn't make sense to go buy dollar in the parallel market, put the money in your DOM account, transfer it to your dollar card, and use your dollar card to pay those expenses or make purchases. Just yesterday. So if you look at all of these metrics, they show significant improvement so far between end of 2025 and 21st of April 2026. So what does that mean going forward? Now, I put some charts here, and it's important for us as professionals that when you are interpreting what the market and economy is saying, you don't stay on what the data says today. Take a look at trends. You get more information from trends than spot data, which is why I put all these charts here. All right, this is the state of the economy, diversified in terms of sectors where activities are taking place and what each of them contributes to our GDP as are the latest available data. But of course, external reserve, this chart now shows you how it is performing. So when you see the bullish run, you can now see this trend as, okay, this is part of what is driving the bullish market. Exchange rates, you can see how significantly lost value when we unified. But after unification, you can see it has been moving within a narrow band, which is why we say in interpreting this data, we said that in Nigeria, the Naira exchange value had been stable since November 2024. That means a run already of almost 17 months as we speak, which is quite significant in data interpretation. Crude oil prices, of course, crude oil production and export. Then inflation rate, which of course Professor Waleke also mentioned in his opening remarks. You can see the pattern there. That black line is the linear, trend line, which shows that inflation rate in Nigeria is trending downwards. But again, you have the all items as well as the food inflation rate also on this chart. Maximum lending rate as at February this year, which is the latest available data, you can see lending rate has started ticking up in 2026. What does that mean? There's always this, what I would say, the trade-off between capital market and stock market, primordially in Nigeria especially, where if rates are going up in the money market, there is lending rates anyway. Now, I have data also on deposits, 30, 60, 90 days, 365, right? All those data available on the website of the Central Bank of Nigeria, which I harvest every day. As they put out new data, we harvest them. So if you look at the trend, what it shows is that, yes, loans are getting more expensive from what you see on this chart, but deposits are not attracting more money, which also means that the attraction of the money market to take investor money away from the stock market is not strong as of today. Of course, PMI speaks to investor confidence, even though this talks to policy managers index. Once it is above 50, confidence is very positive looking forward. But the latest one is for March 2026, which was last month, at 51.9. That means above 50. That means there's a view by policy managers generally that over the next 6 months, that will take us to September, that the Nigerian economy will continue to grow. That's what it means in interpretation. We've seen this before the stock market. So let's now look at how we put all this together. We can then make this inference that number one, fundamentals are strong, and that's the driver of the bull market we have. Secondly, there is increased participation by domestic and foreign investors. That's also driving the market. Then any momentum is also strong and growing. If you look at most of the listed stocks, anytime they come to present their reports, you see the kind of returns that they are showing in terms of earnings. Of course, the reforms also induce investor confidence. And there's what I call robust domestic liquidity, which was proven recently in the bank capitalization, with 3.374 trillion naira coming from local investors. In fact, I discussed this somewhere on Sunday, and one of my friends said, "Sir, there is money in this country." I said, "Yes, there's money in this country. It's about having a proper business case, and then you attract the money." So our banks had a proper business case. And so they attracted investor funds. And of course, as I said earlier on, Nigeria has space for monetary easing, given the dynamics of those variables we discussed earlier on. What is the expectation this year? Only one slide. And I did this deliberately so that for us as professionals, we know what to pay attention to. Now, the first one is, what is the current government's plan for the next 5 years? That's this year to 2030. They call it, Renewed Hope Development Plan. That's what they call it. But whatever name they give to it is Nigeria's plan, because they are the ones running the economy. So what are the things promised in that plan? The government says to deepen reforms and transformation, focusing on these 6 areas. Diversify the economy, industrialize and strengthen manufacturing, revenue and fiscal reforms will still continue, monetary policy and exchange rate management will continue orthodox, but of course, as much as possible, transparently, and also in an accountable manner. Capital market development, so a lot will still happen within our own space, all right? Which, of course, has been some alluded to earlier by Professor Waleke, and of course, the registrar as well. But which sectors will take most attention and resources of this government? And indicated energy, agriculture, manufacturing, trade, then it will focus on innovation and digital economy. So if I'm looking forward, therefore, to how this market is likely to behave, I will look at stocks within these sectors and then interrogate them, what is happening there, what are their own plans. Since I know government says we are going to focus on these sectors. They have about growth, Professor Waleke made reference to this. World Bank IMF 4.1%. Government still retains what it projected in its budget, 4.78, CBN 4.49. Our own firm, we came with 4.51, NSG 5.5%. But one thing is common. Everybody doing projection about the economy of Nigeria in 2026 is at above 4%. So that means there's the outlook, despite what is happening in the Gulf state, that the war going on in Iran, okay, there's still that conviction that the economy is going to grow strongly at over 4%. Now, I picked this out in the research newsletter shared with me by Bangkok Research sometime last week, and I found it interesting. So it says the ASI remains firmly above a 7-day average, okay, that's the moving average, then 20-day average, and 50-day average, indicating that the market continues to trade within a strong bullish trend, which means when you take 7-day, 20-day, 50-day average, and the actual data you are seeing day by day is above those averages, that's a pointer that the market is still growing strongly, and that momentum may likely be sustained, all right? So now, coming to opportunities and what to do to take advantage of them. There are 5 popular strategic initiatives that investors can adopt to effectively manage stock market risks. And of course, they are not mutually exclusive. That means any 2 or more of them can be combined, in fact, all of them. And there's an illustration also have, which will come to shortly. First is portfolio diversification. So in a bullish market, it is compelling that you look at how diversified your portfolio is. That's number 1. Then portfolio rebalancing, which is a language of asset management companies, especially. That is something you do on an ongoing basis. In which case, I have investments in equities. Do I have investments in bonds? Is this a time to move some part of my investment to bonds? And then, of course, fixed income securities and the rest of them. So that's what we call portfolio rebalancing. The long-term perspective, which brings into your consideration what I mentioned earlier on about sunset and sunrise, all right? the research and analysis. And this is what I would say, the aspect I deliberately avoided in this presentation, which is looking at how the market is behaving and the prices of individual stocks are behaving, whether the shape you see in the trends are triangles or they are rectangles. Even the triangles, in what shape is the triangle? So, but I'm not going to all those technicalities. But the idea is that the more research and analysis you do, the clearer insight you get in terms of identifying opportunities and then taking advantage of them. There's also what they call stop loss and risk limits, which I will illustrate for you shortly. But if you are dealing with an international investor who has investment in Nigeria, in, let's say, East Asia, in the Americas, in Europe, then 4 things will become important. First is to do international diversification. As of today, US markets are not as hot as they were historically. We saw that in the numbers I showed earlier on. Then focus also on structural winners, which means you look at each geography. There's one of our banks, but let me make it clear because we should figure it out easily. First Bank. First Bank operates in 8 different countries. So each time I do some work for them, they will say, look, we want you to profile the economies of those 8 countries and then advise First Bank on what to do. But when I'm dealing with Stanbic, Stanbic says, look, we operate in many countries, so we have insight about them all. They talk to us about the Nigerian economy, where we are. So different. So you now look then at, as an international investor, you look at the structural winners in each of the geographies where you invested. Then, of course, you need to embrace sector rotation. I described that earlier on. Of course, monitor emerging markets, which are hot and interesting. Now, these are tactical issues. Tactical means bringing it home to you and to your clients as a stockbroker. First is to reassess portfolio allocation. Stocks and sectors rotation, as I said. Then implement profit taking. How do you do that? There are 3 possible ways, or you can also mix them. You can do partial sell-off. In fact, when I wrote this down, my mind went back to 2016. Okay, then my daughter, my 3rd child, was about to go for masters in UK. Of course, she did a doctorate there as well in software engineering. Now, to pay her school fees, it was difficult to put the liquidity together at the time. So I now said, okay, you know what? Let me approach GTB, because through script issues over the years, the shares I bought in GTB in 2004 had become very significant. Of course, at the time also, we bought for BA Consult. So BA Consult's own stake was 10 times my own personal stake. So very significant. So I said, if I sell a part of my shares of GTB, it should be enough to take care of the school fees of this girl now. So I did partial sell-off, all right? Of course, that brought profit taking as well. You can also adopt what they call stop loss. And that means once the price of this stock gets, let's say, 10% of the current price in the market, then we offload it. That's a stop loss, you know. Or you can do what we call gradual scaling out. The third one is to rebalance to defensive assets. Defensive assets are those assets that have lower volatility. You know, I mentioned earlier comparing Seplat and Boa Foods, okay? You look at every stock in the market and now do calculation of their volatility. That is how, you know, fast are their prices changing. So the ones we refer to as defensive assets are those whose price volatility is very low. Then take account also tax impact, that especially when we now talk about capital gains tax, which is a global thing anyway within that space. So, of course, adopt and use hedging instruments, options, other derivatives, ETFs, a very interesting field as well. Okay, so many of them there, so many. So, but which ones are relevant? And then it reminds me of a particular transaction that BA handled, where the fund was sourced from US, and the instrument to hedge the risk was issued in Singapore. And then we had also insurance done of the loan in South Africa. And of course, the entity that was at the center of restructuring it for us was from Dubai, United Arab Emirates. So look at the geographies involved in one single transaction to fund the project here in Nigeria. So that's the kind of thing that we're talking about here, hedging instruments. There are many and they are diverse. Of course, maintain liquidity, which, as I mentioned earlier, is a classic, one of the classic trial of portfolio management. They set clear objectives. Illustration, just before I close, then we now go into discussion. Let's assume you invested 10 million naira in January 2025. And at the end of the year, like I said earlier, your portfolio mimicked the performance of the Nigerian stock market. So you gain 52%. So your portfolio now is valued at 15.2 million. That's end of 2025. So you can do three things. Number one, you can take part of your profit by exiting 25% of that portfolio. That gives you the value of 3.8 million out of your 15.2 million. Okay. Do a rebalancing by moving 20% of it, which is 3.04 million naira, into government bonds. And then hedge the remaining position. That is to say, we are in a bullish market. How do I ensure I take advantage of this opportunity? Profit taking doesn't mean you sell everything. You can sell a part. It can be 10%. I just illustrated with 25 years. It can be 5%, but at least you can take a little bit of the profit. You can do rebalancing and move a part of that into government bonds. But at the end of the day, when you add 3.8 to 3.04, that's 6.84. Back that out of 15.2, you are still very close to 10 million you started with in January 2025. So your investment in the stock market still remains very close to your 10 million at the beginning of 2025. We now say, okay, to provide a hedge for that, you place a trailing stop loss at 10% below current market value, which means all the stocks in your portfolio, you place a 10% stop loss value on all of them. So if any of those stocks, the price goes 10% below the current value that you have, you say it is time now to move out of that stock. That's what it means by a trailing stop loss, which is hedging actually. So this is just to illustrate how you deal in a bullish market. So let me now conclude and then we can discuss. Now, I did also some search with some AI tools, but I found this interesting principle as put out by Microsoft Copilot Research. So it says consolidation is not about exiting the market entirely, but about safeguarding gains while positioning for sustainable growth. That's why in that illustration, almost 10 million that you started with beginning of 25 is still retained to take advantage of sustainable growth. All right. But it requires three important things, which interestingly, the registrar mentioned in his opening remarks. Discipline is important. Diversification is also key. And of course, risk management. Now, my concluding note. This is adduced to an unknown person, but often attributed to Oscar Wilde. He said, everything is going to be fine in the end, full stop. If it is not fine, then it is not the end, which means you keep interrogating the market, the economy, the data, and of course, correct interpretation, making decisions that will continue to sustain your wealth creation opportunities within the market. So thank you very much, ladies and gentlemen. I will yield the floor back to Professor Owaleke, and then we can take questions and comments.
Yeah, thank you. Thank you so much, Professor Biodu Adedipe. I'm pretty sure you have wowed your audience, including myself.
Thank you very much.
Of course, it didn't come to me as a surprise. I wasn't expecting anything, less.
Thank you so much.
Yeah, so once again, thank you for that insightful and thought-provoking presentation. In the last 1 hour or so, Prof. Biodu has been talking to us on the theme of this webinar, consolidating the gains of the 2025 bull market, strategic approaches for Nigerian investors to achieve enhanced performance in 2026. One interesting thing about Professor Biodu Adedipe's lectures anytime I attend them is that I find them very educative. He seizes the opportunity to educate beyond even what the theme is all about. So anytime you listen to his lecture, you must pick something. That one is more like guaranteed. So we find in this lecture, for example, Professor Abiodun telling us how to interpret macroeconomic data, which is very important. He has shown us in this lecture how to interpret data on GDP, inflation, interest rates, what he called the three macro prices, interest rates, exchange rates, and inflation, how to interpret them in relation to the capital market. He also talked about the PMI, the Purchasing Managers Index, and some acronyms too. He tried to explain to us the VUCA, the BANI, and the rest of them. So, Prof, from your lecture, a number of key points, stand out clearly. First, the strong performance of the Nigerian stock market has been driven by a combination of solid fundamentals. That you brought out very clearly. Solid fundamentals, increased investor participation, robust earnings momentum, and confidence-enhancing reforms. However, the market is now showing signs of consolidation, a natural phase characterized by price stabilization, narrower trading ranges, and a balance between demand and supply. Second, we have been reminded that risk is inherent in the market, as in every other market. Both systematic risks, which you clearly defined, such as inflation, interest rates, and exchange rate movements, and geopolitical developments, and unsystematic risks, which we know are idiosyncratic risks that are tied to firm-specific factors. That this must be carefully managed, you advised. Importantly, timing, discipline, and a clear understanding of market cycles remain essential to investment success. Third, the economic outlook remains cautiously optimistic. Nigeria's growth trajectory is strengthening, as you showed, supported by the reforms, sectoral diversification, and improving macroeconomic stability, even though vulnerabilities to external shocks still persist. Most importantly, the lecture highlighted the strategic choices available to investors in a consolidating market. These include maintaining diversified portfolio to spread risk. This point is very important. He harped on it, maintaining diversified portfolio. He also talked about rebalancing portfolios in response to shifting market conditions. From time to time, of course, based on market conditions, portfolios need to be rebalanced. Adopting a long-term investment perspective, strengthening research and analytical decision-making, and implementing risk controls, such as, he gave an example of stop-loss limits. On the tactical side, investors are encouraged to reassess sector allocation, take profits where necessary, rotate into more defensive assets, what we call defensive assets. He gave examples, maintain liquidity, and explore hedging options where appropriate. The central message from Professor Abiodun's lecture is very clear. Consolidation is not a signal to exit the market, but rather an opportunity to protect gains while positioning for sustainable future growth. Success in this phase will depend on discipline, informed strategy, and effective risk management. Professor Abiodun, you will all agree with me, also talked about the need to watch trends in the economy, trends in the market. So that's speaking more to the technical side. He also emphasized the need to look out for fundamentals. So essentially, combination of fundamentals and technicals has been advised here by Professor Adedipe. On behalf of our great institute, I want to thank Professor Biodo Adedipe, our speaker, and indeed the over 100 participants of this call for your engagement. We trust that the insights shared today will support better investment decisions and contribute to the continued development of our capital market. The president of the Chartered Institute of Stockbrokers, other council members, registrar, the leadership of the CIS Academy, it's indeed my great pleasure to moderate the presentation by Professor Biodo Adedipe. At this point, we'll open the floor for comments and questions and contributions. So if you have any comment to make, you can raise your hand and I will recognize and invite you, introduce yourself, and then make your comment, contribution, or question. So we're all here to respond to your question. Do I see a hand up? Okay, so Professor Biodo, on the comments on the chat box, I can see a number of commendations for the paper. Thank you. Wow, thank you, Prof, for this paper. We appreciate. That's from Olatunji Daniels. Thank you, sir, for the super presentation from Olatunde. Belumi is also thanking you. So we have a number of them commending your great presentation. So do we have any comments, contribution, question?
Or is it like the military say, all correct?
Yes. Yes. So if you have, you can raise your hand and then you'll get recognized. Okay,
that's good. The hand is up now.
Okay, yeah, go ahead, Mr. Owolabi. Go ahead, you're recognized. On mute.
Thank you, Prof.
On mute, yes.
Okay. Yes. Thank you very much, Prof. And thank you, facilitator. We really appreciate your presentation. I just want to appeal or request that the material be released on time so that you can actually read it and digest it along with what we have had him delivered verbally. So that will make us to be able to catch up with what we have had. So I'm just pleading for an earlier release of the materials. Thank you very much, sir.
Yeah, thank you. That point is noted. I assure you, all the participants here will get the presentation as soon as we are done. Thank you. Okay, any more hands?
Somebody put a question in the chat box. How do we get the projected 4.51% growth of the GDP for 2026?
Okay, so Prof, I think it was your firm that is projecting 4.5.
4.51, yes.
That's your firm. The central bank is projecting something lower than your
4.48.
4.48, yes.
4.48.
And the World Bank 4.1. So how did you get 4.5? Right. That's the question. Go ahead.
Okay. Yes, thank you very much. Now, when we do economic outlook, there are a number of factors we look at. And for us in BA Consult, we usually start from the Nigerian population and then the structure of that population and the spatial distribution. Then we look at the major drivers of the economy, not only in terms of sectors contributing to the economy, that's to the GDP. We also look at the growth drivers, which sectors are growing fastest. So then we look especially at technology. Where is Nigeria in terms of internet penetration? Where is Nigeria in terms of netizens? Netizens will be the number of citizens with access to internet. And then, of course, we look at the digital economy as well, how that is growing. So going beyond that, we now look at specific industries that we reckon are important. We look also at significant game changers. I mean, by all means, if you look at the Dangote refinery, it's a major game changer for the Nigerian economy. And in fact, in something I did not speak to, and that is the current crisis going on globally. Countries all over the world fell into 4 groups when we play with resilience and vulnerability from 2 major perspectives. One is whether the country has strong buffers or weak buffers, and then whether it is vulnerable or not vulnerable in terms of dependence on other countries for oil, whether as crude oil or refined products as white products, as we call them. Now, for Nigeria, we fell in the category of countries that are resilient because of where our external reserves presently is at, having over 12 months cover of our import bills. Minimum for strong buffer is about 7 months. That's why you find the countries like India and the rest of them. So Nigeria is in the category with strong buffers. That's number one. Then secondly, where we were 3 years ago, we are completely away from it this year. 3 years ago, we were net importers of refined petroleum products. Whereas today, we still import refined products, but a lot of what we consume, close to, about 52% thereabout, is sourced from Dangote refinery. So that changed the arithmetic. Of course, looking at the numbers. So by the time we put all of this together, we form our own opinion as at early January this year that we expect the Nigerian economy to grow by 4.51%. It was after we issued our own outlook that Central Bank issued its own at 4.48. Of course, about that week also was when the World Bank issued its Global Economic Prospect, GEP, where they said they expected Nigeria to grow at 4.4. But they dampened 4.4 to 4.1 when they did their April review. IMF did the same thing from 4.4 to 4.1 in their April review, which was issued last week. The BA Consult still maintains 4.51. And of course, CBN has not changed its own as well. NESG is even more aggressive than all of us at 5.5%. So, but as Professor Waleke said, it is cautious optimism. But everyone is talking about the reforms and the capacity to sustain it. Why do we talk about capacity to sustain it? We've seen the reforms now in the last 3 years, no reversal yet of any. So looking forward, we then say for the rest of this year, there's unlikely to be a reversal of any of those major reforms. And if that is the case, that means we expect this trend to continue. So now, if we look at that, and of course, the other issues going on with reforms at the sectoral level, that's why we came to the position that as of this April, we don't see any reason to revise our own expectation for 4.51. We still leave it there. Usually, entities doing outlook do that 4 times in a year. Okay? They do it beginning of the year, then April, then July, then October. So, which means as every quarter ends, we all return to the drawing board, review the data available, and then update our outlook. So that is how the thing works out. Somebody put a question there, I think in the chat box as well, about, okay, now this one that came is very interesting. Say, call the winner of the Nigeria election.
Are you? Thank you. That's outside the scope.
Exactly, it's outside the scope of this conversation. So thank you, Prof.
Yes.
So
thank you. I think we have Jimo. Yeah, Jimo's hand is up. So we take Jimo now. After taking Jimo, we will now find out whether Dr. Akeem Oyewale, the second VP of CIS, will want to say something. I can see him on the call. Okay. That's after Jimo. Yeah. So Jimo, you have the floor.
Okay. Good morning, Prof. Good morning, everyone. Let me thank Prof. for a very insightful and wonderful presentation. May Almighty continue to increase your knowledge
Amen.
My own questions, we that we are working in a private organizations, a manufacturing company, you made
Yeah.
mention of the type of risk. How do we in this current economy, how do we maintain on systematic or specific risk in line with the economic situation in the country, and we are in some month of these times, the campaign for the next election will
Commence.
be open, yes, commence. So how do we maintain the unsystematic risk together with performance driving, especially FX exchange rate, official and parallel? So that's number two. How do you assist some of us that are very young in this industry? I qualified in 2021. And with your wealth of experience, I believe you should be a light and guidance for we that we are incoming generation, so that we also can have a very impact on our institutions. Thank you, sir.
All right. Thank you so very much. Now, to your first question, I may not be able to give you specific response to your own sector, but what I can say here simply is that, number one, you made reference to exchange rate, and I will say something there. There's what we call policy guidance issued by either the governor or the CBN or maybe chairman of the Reserve, Federal Reserve, depending on the jurisdiction you are looking at. So now, our own central bank governor gave a rate guidance about 2 weeks ago. And he said, the Naira is not going to be devalued for the rest of this year. We call it policy guidance. In fact, the Japanese that began that around 2005, thereabout. The Japanese, of course, started year 2000 with the first ever zero monetary policy rate, okay? Because they were responding to the stubborn East Asian crisis that began in 1997. So the Japanese, of course, were forefront in terms of innovation in central banking. So they were the first to try its guidance. So our CBN governor did that about 2-3 weeks ago. And he made a statement that the Naira is not going to be devalued for the rest of this year, that every player in the Nigerian market should be assured of that. Of course, people like us, we know that there are 12 factors that drive movements in exchange rates. So if Central Bank of Nigeria has gone orthodox, it means the policies are driven by what macroeconomic data says and what the market is saying. So all we did was go back to those factors and interrogate them. What do they say as at now? Is what they are saying, and also expectations going forward, do they suggest or an alignment with what Cardoso said? And we came out with yes. So demand and supply nexus is number one. Of course, we talk about also interest rate differential between Naira and dollar. We talk about inflation rate differential between Naira and dollar. We talk about inflation expectation, the state of the banking industry, the state of the economy. We talk about capital flows, all right, net capital flows. We talk about significant utterances of key government functionaries. We talk about economic policy of the government and a few others. So when we interrogated all of this, we aligned with Cardoso that clearly there is no basis for the Naira to lose value. So you can therefore take that as a position today, April, that all the data and analysis indications with what the CBN governor said, don't think about Naira devaluation this year, all right? Remember I mentioned in my presentation that countries like Egypt, having 7 months cover of foreign reserves, we are said to have strong buffers. Nigeria, as yesterday, had 12.23 months cover, which you can say is almost double that of Egypt that is considered strong. So, and of course, there are a number of other things we looked at, which is why Nigeria is even stronger than South Africa in this regard. If you take external debt service for this year, you see Egypt and South Africa coming weaker than Nigeria relative to the external reserves. South Africa has around $80 billion. Yes, nominal terms, more greater than Nigeria's, $50 billion. But in reality, play that against their external debt servicing obligations for 2026, then they come weaker. Same thing applies to Egypt with about $26 billion, servicing cost for 2026. So when you look at all of this, what they point to is that the Nigerian macroeconomy is stable going forward. And in an environment like that, Naira certainly will not be devalued. So coming to manufacturing, it will now be a matter of which sector are you? Then if I pick up your sector, we now say, what is your ranking as a player? Are you top 5? Or you are one of those who play the fringes? Because all of these are issues in defining survival and growth strategies in manufacturing. Which incidentally is like you are peeping into the next paper I want to present this afternoon. Once I'm done here, I'm on my way to present the paper on this very question you asked. Survival and growth strategies in the turbulent market environment companies operating globally. But now we domesticate it and bring it home to Nigeria. So but thank you very much for that question. It's noted. Again, the guidance is all about harnessing your experience and also making a lot of sense out of the data and information you're exposed to on an ongoing basis. Like I always tell professionals like ourselves, we stay away from politics. We stay with what data says. If you stay with the data, you can't get it wrong. The only challenge anybody can give you is a question on the integrity of the data. And when they raise that question for me as a Nigerian, I take them back to the days of 1970s, 80s, when we had Federal Office of Statistics. I know what it was like in 1988, when I went to FOS office in Ribadu Street in Ikoyi, and I needed data on the steel sector that we're working on at that time, a World Bank project, okay? And they showed me a room where they were printers of computer, a whole room. Of course, it meant if I needed data, I would need to bury my head in so many computer printout to get it out. But it's different today. You have a more functional NBS, National Bureau of Statistics. So we have come a long way. And to that extent, people like me, I have a lot of confidence in the data we turn out. And of course, mostly, I use data harvested for the website of Central Bank of Nigeria. So to that extent, I play safe and stay with data. So thank you very much. So that's my advice to professionals.
Thank you very much, Prof.
Yes.
Thank you very much, Prof. Yes, I very much agree with you. We should stay with data. We should be data-centric. Stay with data, and also, of course, monitor forward guidance. Forward guidance and signals, coming from the Central Bank of Nigeria. Again, as I mentioned earlier, let me reiterate that macroeconomic stability will help consolidate performance in the market. With the new law that we have, the Investment and Securities Act, that is stronger than what we used to have, stronger financial institutions following recapitalization of banks. One can be sure of better market performance in the coming days. And if you look at the way the market is performing as well, in terms of sectoral performance, gone are the days when maybe a single sector would be lifting the market. In those days, the banking sector will lift the market, and then the other sectors will be down. But today you have year-to-date return at about 40%. In the oil and gas is doing 97%, year-to-date return. Industrial sector is doing 57%. Banking doing now 49%. So it's becoming a lot more broad-based than we used to have. And all of this, one can anchor on the confidence that has returned, to the Nigerian economy. So may I now find out whether Dr. Akeem has anything to tell us?
Yes,
before
I do.
Okay, Doctor, go ahead, please. Doctor. Yeah.
Okay. Good morning, everyone, and my great thanks to Professor Biodun Adedikwe for your quality presentation as always. Also, I would like to thank our member, Professor Uche Waleke, for moderating the session so far. On behalf of the president, the 13th president and chairman of council of the Chartered Institute of Stockbrokers, I would like to thank everybody, that has taken out of their time to participate in this session today. We've listened very, very well and clearly to all the points that Professor Adedipe has shared with us. And I hope that we'll be able to leverage on all of the teachings, and the ideas he has shared for us to have a very successful 2026 as well. Professor Waleke, we thank you for always answering us each time we call you. You are a very, very as the first professor of capital markets, on the continent, you are a star that we are always proud of, and you've always demonstrated that. So we thank you so much. To all my team as well in the CIS Academy and the whole team at the Chartered Institute of Stockbrokers, we also appreciate you for putting this together and allowing our members and other folks in the industry to actually participate from such a rich conversation this morning. So once again, on behalf of the principal officers, the 13th president of the CIS, and all members of council, I would like to thank everybody that has spent out of their time to be here this morning, and our revered lecturer and moderator as well. Thank you for joining us this morning, and I wish everyone a very, very good day. Thank you all.
Thank you. Thank you very much. Professor Biodu Adedipe has another engagement, and that is why we have to bring this to a close. May I now invite Dr. Cephas Adewale, the CEO of the CIS Academy, for closing remarks. Dr. Adewale, I'm handing over to you.
Thank you so much, Prof. The closing remark has been said by our VP, Vice President 2 of the Institute, but I want to just sincerely thank you for the opportunity given to us by moderating this, and also our Professor Adedipe also. Thank you so much. The CIS Academy is really proud of you, and we are very, very grateful.
Thank everybody.
And I want to also thank everybody for their time and contribution to this breakfast session that is successful today. Thank you all. We are grateful.
Yeah, thank you. Thank you, Dr. Cephas. I'm sure you have the list of all the participants to ensure that they get the presentation, as soon as we
have them. We have them.
All right. Okay. So on this note, it's my pleasure to bring this webinar to an end, and we look forward to another exciting edition in the very near future. Professor Biodu Adedipe, may God bless you richly, and may God bless everyone and the Federal Republic of Nigeria. Thank you.
Amen. Thank you, Prof. Thank you, everyone.
Long live the Chartered Institute of Stockbrokers, and long live the CIS Academy. Thank you.
Thank you for having me.
CIS Academy.